Hi everyone, my name is Niki Ariyasinghe. I lead business development in APAC in the Middle East for Chainlink Labs. Thanks for being here today. So when we talk about cycles in blockchain, typically people talk about price cycles. Price of Bitcoin, the price of crypto, bull markets, bear markets, and everything in between. But what I find quite interesting is the utilization of blockchain technology in real-world applications. And its adoption, particularly with large enterprises, financial institutions, primarily because it has the potential to impact millions and millions of people. So what I'd like to do today is to walk through a little bit of the cycles in enterprise adoption, particularly over the last 7 years or so. Talk a little bit about Chainlink's role in all of that, and potentially talk about how this may all pan out. So I've been involved in the sector in enterprise since 2016. So let's just start with a little bit of a walk down memory lane. So some of you may know this, some of you may not. But in 2016 to 2020, that was really the first cycle in enterprise blockchain adoption. And it was full of optimism and experimentation. You had great headlines like Forbes talking about how blockchain technology could change the world. That's what brought a lot of us into the space as well. You had large corporates join the space, Microsofts of the world and so on, looking to utilize the technology. And interestingly enough, you also had the first emergence of consortiums, consortia. So these are really organizations that exist in everyday corporate environments, banks, insurers, shipping companies, healthcare companies, doesn't matter. But importantly, they're typically competitors. They don't play well together. But there was something interesting and intriguing about blockchain technology that prompted these organizations to come together to form consortiums and try and look at how this technology could add value to their businesses. What's also interesting, and some of you may know this, some of you may not, but this was also an opportunity for large and really impactful businesses to experiment with their businesses but their business models. So Circle, obviously very well known for being one of the primary stablecoin providers, but back then, it was actually a competitor to Coinbase. It was about buying and selling Bitcoin. And so obviously they pivoted. So full of optimism, full of experimentation. And then the environment shifted, 2020 to 2023. A pullback, the trough of disillusionment. Suddenly the headlines changed. Blockchain fails to gain traction in the enterprise. Consortiums started to fall apart. You had organizations that weren't willing to put more money in to take some of this technology forward. And you had very large technology projects, including here in Australia with the ASX, where the blockchain project was written off after 6 years of effort. Now, this isn't necessarily a negative indicator of the technology itself. There are many reasons how this all panned out. Sometimes some of these consortium models just ran out of money. Sometimes the challenges were too great to achieve in such a short space of time. I wouldn't underestimate the level of entropy that exists in corporate environments. And sometimes it just had nothing to do with the technology at all. But nonetheless, over a multi-year period, there was a pullback in how blockchain was applied in the enterprise space. So now, over the last 6 to 12 months, essentially 2023 onwards, now we have the rise of tokenization. And the headlines are back. Citi talks about the killer use case for blockchain, finally. Others talk about a $10 trillion market for real-world assets by 2030. Or another way to look at it is 50xing the size of the market in the next 7 years. So I think optimism is back, lessons have been learnt, but importantly, new organizations are trying new ways of applying the technology to try and really achieve value for their businesses and for their customers. So how does Chainlink fit in all of this? So some of you may know this, some of you may not, but Chainlink essentially solves two key problems, one of which we're very well known for, and this is in solving the Oracle problem. One of the challenges is, of course, that you can't bring off-chain data onto a blockchain securely and reliably in a very easy way. It's a very hard thing to do. And this is something that Chainlink has solved for over the last 4 to 5 years. We've been bringing particularly price data, which we're very well known for, onto a range of blockchains. We're currently connected with 15 blockchains. What this means is, at any given point in time in DeFi, which I know many of you are here for, at any given point, between 60 and 80% of assets are priced via the Chainlink network. So we're integrated with 15 blockchains, and we have a decentralized network of Oracle node operators that provide this particular service via an even wider network of data providers. The exciting part about the node operators is they're battle hardened. You have very able, very strong crypto-native organizations right through to the Vodafones of the world, which run a node on the Chainlink network. And so how has this manifested itself? So over the last few years, we've brought 10.3 billion data points on chain. And this has really been a significant catalyst for that first phase of DeFi that has occurred over the last few years. We've brought so much value to the ecosystem. So as last estimate over the last 2 years, $8.68 trillion of value has been exchanged on the basis of those price feeds. And this is going through many of the applications that are the exciting ones that are being built in DeFi, as well as many of the L1s and L2s and so on that are providing the core infrastructure for enabling those applications. So we really have this kind of base, very strong, highly decentralized, highly secure, and highly reliable network. So then that's one side of the equation, what Chainlink does. Should we look about tokenized assets? So you would have heard many examples, but I think it's good to zoom out in these particular instances and look at some of the real numbers. So I mentioned $10 trillion, but the World Economic Forum actually estimates the broader market, the target addressable market for tokenization of assets at $867 trillion, which is hard to imagine, but across a wide range of sectors. The second part that's really interesting, and perhaps what's quite different from those earlier cycles that I mentioned, is that people are aligned in terms of the value that tokenization can bring. BNY Mellon, one of the world's largest custody banks, looked at their investor base, and there's a very strong correlation. There's a strong belief that the time for tokenization has come. That period of experimentation is over. And the third aspect, which is quite important to understand, is, again, for those of you who may not be familiar with financial markets, to try and envisage, to look for a mental model of what is the value that tokenization will bring. And one simple example to think of is the fact that financial markets today do not operate 24/7, 365. The Australian Stock Exchange shuts down at a particular point in time. Fixed income markets shut down in Europe at a particular time, and so on. And a simple example to think of is in tokenized markets with digital assets that can trade 24/7, 365. You can imagine how this can grow the liquidity in a market, the velocity of a market, and so on. The second part that's really quite interesting is also the types of use cases. And obviously there's a plethora of different use cases, but some that we have heard from the organizations that we work with. One is private debt. So tokenized bonds is a classic use case where there is no formal structure, there is no formal exchange that provides support for the selling and buying of particular bonds. So in this particular case, blockchain can lend itself quite readily to helping this particular market. But another interesting use case is real estate. So the ability to tokenize real estate, and APAC is really at the forefront of this. Both in Hong Kong, locally in Australia, you have startups that are looking to tokenize commercial real estate, tokenize retail real estate. So the literal, like a single home, and actually tokenize that and the title to it. What's exciting about all of this is that's one side of the equation. So you have this tokenization of digital assets. But the other aspect that's really, really exciting as well is the tokenization of fiat currency and deposits. So obviously many of you will be familiar with stablecoins, but what's also coming down the pipe, central bank digital currencies issued by central banks, tokenized deposits issued by commercial banks as well. And we believe all of these will play together in some way, shape, or form. But the exciting part is what all of this unlocks once you start to tokenize these particular assets. One aspect is integrity. So I want you to imagine a particular transaction where you have a bond or any other financial instrument really, and it could even be the tokenized real estate that I mentioned. On the other side of the equation, you have a buyer who's going to pay in some form of cash, and let's call it tokenized cash for now. In a typical environment, particularly in commercial banking, that type of transaction can take multiple days. There's a significant amount of counterparty risk involved, even though those organizations typically interact over a multi-year period. And so the one ability of tokenization is really to minimize that level of counterparty risk by reducing the period of time taken for those particular transactions. The second one is in automation. Some of you may not know, but some of the largest transactions, the most popular financial instruments in the world actually get governed by highly outdated computer software or even sometimes spreadsheets and phone calls, even in this day and age. So there's very much an efficiency play to be had. The third element is liquidity, and we'll talk about this in more detail. But there's an opportunity to really enable this seamless interaction of assets and cash and enabling far more velocity in terms of interactions. And the last part is transparency. We've seen with so many of the issues that have cropped up, both in crypto, but also in broader banking, where there's a need for auditability of transactions, of assets, and so on. And that's really the promise of what tokenization offers. So you have on one side this significant market. You have interesting use cases. And then you have potential efficiency gains and value that can be created as a result. But there are technical limitations. Now, blockchains are not connected, and they're not connected in a multitude of ways. One, blockchains aren't connected to the enterprise stack. So some of you may not be aware of this, but you can't just deploy a blockchain and then expect a corporate entity to suddenly interact with it. It has to be integrated in a wide range of their particular systems. It has to be able to operate behind their firewall. So this is one of the key problems that needs to be unlocked, that needs to be solved for if we're going to take tokenization forward. Two, blockchains can't talk to other blockchains. A very simple fact of life. In the DeFi world, we've depended on specific types of bridges to try and solve this, at least in a stopgap way. But as of last count, we're at $2.6 billion in bridge hacks and counting. So fundamentally, it's not just about enabling blockchains to interact, but it's also about doing so securely and reliably. Three, thinking about it from a corporate standpoint or for a large institution standpoint, there's a growing patchwork of blockchain tech. This is just a subset. You have L1s, you have L2s, you've got a whole range of very interesting applications being deployed in DeFi that are now starting to converge with TradFi. You've got the banks deploying their own platforms. You've got a whole bunch of KYC and AML platforms and new players that are emerging into the market as well, focusing on tokenization. If you're a bank, if you're a large enterprise, this is firstly confusing, but importantly, strategically, you start to question, where do I place my bets? Should I have to interact with 20 different blockchains in order to enable tokenization? Or is there a simpler way? So this is where the second problem comes into it and what Chainlink is looking to solve. This is the interoperability problem and being able to enable users, both in DeFi as well as in TradFi, to share value, share tokens, share messaging seamlessly, securely, and reliably across different blockchains, L1s and L2s. And importantly, part of the secret of this is leveraging that battle-tested infrastructure that I talked about earlier. There's a decentralized Oracle network that currently underpins our price feeds and bringing that to bear for solving this interoperability problem. So the offering that we've launched just a few months ago is called CCIP, Cross-Chain Interoperability Protocol. And it's a universal integration gateway that enables this connectivity. So those three issues that I talked about earlier, this is what CCIP solves for. Firstly, CCIP enables banks, large institutions, to integrate with their particular systems, so their corporate systems. Two, then once you have tokenized your particular asset, enable that to be transferred securely and reliably across different blockchains. And three, if that entity decided that they didn't want to integrate with 5, 10, 20 different blockchains, they can do so via CCIP seamlessly. Let's talk about a real example that's really bring it to life for you. So one of the key projects that has really taken this forward has been our work with SWIFT. So those of you who don't know, SWIFT is the largest banking network in the world. There are 11,000 banks that are part of the SWIFT network, and they currently enable messaging between all of these different banks to enable cross-border payments and cross-border securities transactions. At any given point, the bulk of the world's payments flows through flows or is aligned via the SWIFT network. And when we worked with SWIFT, we wanted to do two things. One is we wanted to engage firstly with the broadest cross-section of financial institutions. So we worked with DTCC, which is the largest securities depository in the US, and a range of banks and traditional exchanges, including a local blue bank here in Melbourne. But importantly, there were two aspects that were really critical to test. One is that cross-chain interoperability piece. One, could you issue an asset on, say, public Ethereum? And could you then transfer that onto a public permissioned chain or rollup? Secondly, could you then transfer that particular asset from a public chain to a completely private chain? And so this was a success in terms of the token transfers, but there was a second understated part which was really critical to understand. By each of these banks being able to use SWIFT, not much changes for how they do business. They don't necessarily have to integrate a completely new blockchain. We in SWIFT have done the hard work to enable an integration. Essentially, a bank then initiates a transaction via their current SWIFT messaging system. It goes to SWIFT, which then goes to Chainlink, which then enables this transaction flow. The issuance of an asset, of a digital asset, a transfer of a digital asset across different blockchains. So this is super exciting. It's received a lot of great feedback, and this is something that we're looking to take forward, SWIFT and plenty of our other partners as well. But why is this important? Like, what is the actual business value of any of this? I think one of the key learnings that I've had over the last 7 years in enterprise blockchain is people tend to focus on the tech, but ultimately, if the tech is going to be deployed, it really comes back to business value. And so over the last 6 months, we've spoken with well over 50 leading financial institutions, banks, asset managers, and financial market infrastructure providers. And there's really 3 categories where solving this interoperability problem adds value to their businesses. One is in connecting pools of stranded assets. So I mentioned earlier in the discussion that we had early deployments of blockchain. And while some have fallen by the wayside and haven't been funded and so on, some have continued. Some have continued to build. But it's interesting the way large conglomerates work is you have plenty of instances where one part of their business is deployed in production on a particular trade finance network, another part of their business is deployed on a particular payments network, and they're not connected. And importantly, they're on 2 different blockchains. So they can't connect, they can't transact, which for an entity, for the same company. And so this is a lot of the feedback we've received is particularly for some of those early movers, they want to connect up these pools of stranded assets via CCIP. The second one, and fundamentally the most important one, is maximizing liquidity. And I can't understate this enough because it comes up in literally every conversation. If you issue a digital asset, tokenized bond, tokenized real estate, whatever it is, it doesn't matter. If you issue some form of tokenized cash, central bank digital currency, stable coin, and so on, the challenge is you want to reach the widest possible audience, the widest possible set of possible investors. And if you sit on one blockchain and your expectation is that everyone is going to come to that particular blockchain, it's just not going to happen. And so we've heard this from banks, we've heard this from digital asset providers, we've heard this from asset managers and so on. And fundamentally, it all comes back to maximizing liquidity. You want to enable that connectivity. A good mental model to have, some of you may remember this, some of you may not, but at least in the early 90s, in the early days of email, you could only email people within your particular email service. So you could only email other people who used AussieMail, who used AOL, et cetera, et cetera. It was only when they finally unlocked the ability to email anyone else in the world and any other email service provider that you really had the explosion of email. And it's a similar thing that we believe with tokenization is you need to be able to connect up all of these assets that sit on different blockchains. The third one, and probably the most, let's say, understated part, but super critical of the way we believe the way the world should work, is it all comes back to reliability and security. So if you're a large enterprise, if you're a large bank and you see some of the issues that have occurred with particular bridges in the crypto space, that's not a risk that you're willing to take. You want to know that whatever you deploy is deploying on something that is enterprise grade. So that's some of the value, but let's look at some of the challenges as well as we move forward. So all of that being said, the technology offers a tremendous amount of value. But putting the technology to one side for a minute, there are still other mechanics that need to be worked through. One is the classic chicken and egg problem where you have an issuer of an asset, you have an investor base that is used to doing business in a particular way. So how do you grow that organically over time? It just takes time sometimes. But it's not an easy thing to change people's set mindsets about how the way things should work. The second one is non-technical, and I wouldn't underestimate this fact, is you can deploy technology all you like, but if you want to deploy it in production settings, particularly with regulated financial entities, it always comes back to legal and compliance. And in fact, when we look at how some of these live transactions and production deployments occur, the bulk of the work is actually on the non-technical side. And the third is competitive dynamics. I talked about consortiums very early in the enterprise blockchain space, but in fact, what you have is not necessarily consortiums Mark II, but you have groupings of entities that are emerging now that are joining particular platforms. You may have a bank like ANZ, for example, locally that has its own platform that can interact with a whole range of other different entities. But then you can have a group that's occurring, for example, like in Singapore with an entity called Partior, which has 5 different banks involved. The reason why I flagged this challenge in terms of competitive dynamics is at a certain point that becomes a hindrance sometimes for entities wanting to transact with each other because everyone's looking for an advantage. But again, none of these challenges are insurmountable, but importantly, they're all non-technical challenges. So then looking forward, what does this timeline look like and how do we think that it's going to pan out? What we can see clearly, and we work with well over 40 institutions globally, is in 2024, and actually this began in 2023, but there's 2 things that are going to happen. One, live transactions. And what I mean live transactions is transactions that occur in a blockchain that have real value involved. If you're issuing a bond, it will be worth, say, let's call it $100 million of real value rather than testnet transactions. Some of these have occurred sporadically, but they've typically been in pilot environments. But the difference now is that we're shifting to production deployments. Particularly banks are taking the leading role in deploying their own platforms. Some that are relatively well-known globally, Goldman Sachs, Broadridge, which is a technical provider, and many, many others, including Citi and HSBC, have all made announcements around their particular tokenization platforms. They believe that this opportunity is coming. So 23-24 is really about putting in that base level foundation. Then what we see happening in 2024-25 is catalyst transactions, not just one-off transactions, but verticals, particular types of transactions, starting to move real volume onto these particular platforms. So not just one-off transactions by any means. So one that is publicly well known is Broadridge and their repo platform. So they have over $70 billion of transaction value that goes through that platform every day. And that's blockchain based. And so this will just replicate itself over a whole range of other different verticals. And once you have those catalysts in place, then we believe 2026 onwards is the point of acceleration. So how do I bring it back? So we talked initially about a little bit of the history of enterprise blockchain and its adoption. And it has been challenging. There have been plenty of lessons learned. There are projects that have been tried and experimented with that have fallen by the wayside. But importantly, some have kept building and others have now joined in. Secondly, the potential for digital asset tokenization is vast. We looked at obviously some of the significant numbers there, but what's important, what's aligning is the proof points are there. Large organizations and entities are building, they're adopting the technology. And we believe that interoperability, like that email example that I gave, is the key to unlocking this asset tokenization vehicle. And the last piece of the puzzle is we believe in 2024, 25, we see these production deployments happening. We see verticals starting to be deployed onto these live platforms. And we genuinely see this acceleration going to happen thereafter. So how do I bring it all together? Fundamentally, the opportunity is significant. Do we believe that $10 trillion of real-world assets would be tokenized by 2030? Yes, absolutely we do. And we look forward to working with many of our partners, the institutions that we work with, both on the TradFi side as well as on the DeFi side, to bring that to reality. Thank you. Enjoy the rest of the conference.